Advanced Micro Devices is trading at an extreme distance from its historical valuation anchors. The market structure underlying the asset is under significant mathematical tension. To measure this detachment, we look at the active underlying spot price of $521.54 and compare it to the price points that typically anchor the stock. When the spot price ignores these technical boundaries for this long, it indicates that the current move is being driven by mechanics that reside outside of standard technical trend analysis. This lack of reversion is accompanied by a second anomaly. AMD's implied volatility is currently in its 98th to 99th percentile. This means options premiums are currently hyperinflated. Statistically, an IV percentile this high is a leading indicator for a volatility crush, where the price of options contracts collapses as the market stabilizes. Standard quantitative models suggest that when you combine this level of price extension with extreme volatility, the result is usually a sharp downward liquidation. But instead of falling, the price has continued to move toward new all-time highs. At this level of volatility, the immediate price action is dictated less by the asset's intrinsic value and more by the hedging requirements of the dealers managing the options chain. In the options market, gravity refers to the tendency for a stock price to settle near the max pain node. This is the strike price where the highest number of options contracts expire worthless, minimizing payouts for the market makers who sold them. This table shows early June targets. The primary anchor is $510, with call resistance at $520. Moving forward, we see a downward migration, pulling max pain to $500. This sustained put interest acts as a gravity well, reinforced by a ceiling and structural floor. This setup creates a put skew. Institutional investors are paying high premiums for downside protection, essentially betting that a reversion to the mean is imminent. If the spot price followed the path of least resistance for the options market, it would already be falling toward the 470 level. But the actual flow of capital shows that AMD is currently overriding this gravitational pull. Over the last 5 weeks, the asset has consistently closed above its max pain target. This data shows a clear pattern of momentum outperforming the expected settlement nodes. On average, AMD has settled 19.49% above its weekly target. This defiance is the result of continuous, high-velocity institutional call buying. When traders buy calls, market makers take the opposite side of the trade, leaving them with short gamma exposure. To manage this risk, they are forced to buy shares of the underlying stock to remain delta neutral. This creates a gamma squeeze, an upward liquidity vortex, where the mechanical need to buy shares pushes the price up, regardless of where the max pain targets are. If we account for this ongoing momentum with a conservative 15% gamma overlay on top of current settlement targets, we get a very different set of price targets. As long as the volume of call buying remains high, the mechanics of the market point toward a trajectory reaching the $535 to $540 range. However, this momentum loop is fragile. It relies entirely on a constant stream of call buying, and that buying is becoming expensive. With implied volatility in the 99th percentile, the cost of these call options is becoming prohibitive. At a certain point, it becomes too expensive to keep the squeeze alive. At the same time, time decay, or theta, is accelerating. For the daily and weekly options expiring in early June, the extrinsic value of those contracts is evaporating by the hour. If the stock price stops rising and begins to move sideways, theta decay drains the value of those calls. As the value drops, the market makers no longer need to hold their hedge positions, and they begin to sell their shares. This is the short gamma trap. The moment momentum stalls, the mechanical buying that supported the stock vanishes, and the price is left vulnerable to the gravitational pull of the options chain. The current option cycle is centered on a specific friction point at $500.18. This level acts as a binary inflection point. The market's reaction at this price will determine whether velocity or gravity wins out. In scenario A, the price successfully holds the pivot and secures a daily close above the prior all-time high of $527.20. This triggers a new round of short gamma covering, as market makers who are short top-heavy calls are forced back into the market to buy shares. This feedback loop can accelerate the price directly toward the $540.50 level. Crossing this threshold forces market makers to purchase the shares that finance the next leg of the move. Scenario B occurs if the volume of call buying exhausts and the price drops below the $510.18 pivot. In this case, the volatility crush begins. The inflated premiums collapse, and dealers begin to rapidly unwind their call hedges. Dealers then liquidate their shares into the open market to maintain a neutral position. This unwinding of positions, combined with the extreme technical extension, points to a potential 10% to 12% snapback. The likely destination is the $470 monthly settlement magnet. In these environments, volume velocity is the only reliable metric. To understand the next move in AMD, traders must watch the reaction at the $510.18 friction point and follow the mechanical response of the market makers.